All right, we have more changes unfolding in the U.S. financial system and the U.S. real estate market. Changes that have the newly released bank concentration numbers for 2024 just out, and they are big, way bigger than previously thought. This is bank concentration to maturing CRE debt, maturing commercial real estate debt, loans that are maturing this year in 2024. Now, we knew the numbers were big, hella big, but it turns out they are even larger than previously thought after many borrowers, many of these big real estate investors took advantage of extensions on their mortgages and moved their maturity dates out to this year. Wait till you see this. The top economist assigned to the CRE space at Goldman Sachs just released a report about this, breaking it all down, and it's not looking good, folks. It's not the real estate investors that we should be worried about, but the banks that hold the paper on these loans are completely underwater right now. The CRE market is in the tank. Property prices are falling, and many of these borrowers are already failing to make their payments. We'll show you that as well. But before we get started, thank you for liking and sharing these videos. It really helps out the channel, and consider subscribing so you don't miss these regular updates. All right, so what's happening in the CRE market? Well, it's been a few months since we covered this, mostly because there just wasn't much going on, but that all changed last week after these new bank concentration numbers were released, scaring the pants off Jerome Powell. We'll look at a video clip later in the video of that and showing just how much money U.S. banks are on the hook for this year, a lot.
There will be bank failures.
Now, we're going to look at Goldman's report in a minute, who, by the way, is usually very reserved with their analysis, rarely taking the bearish perspective, but not this time, not on CRE and not on the banks, specifically the regional banks they say to just stay away from, that they're in trouble. Here's the thing. It's not so much the property owners, right? The real estate investors that analysts and policymakers are concerned about. Obviously, it's unfortunate that they're in this position as well, but it is what it is. It's largely big real estate investors in the office space that are in the most trouble. Likewise, multifamily is also seeing rising defaults as well. But again, not the primary concern. The problem is the banks, the financial system, and contagion, possible contagion, like what we saw during the '08 meltdown. Bad mortgages in the resi space caused an all-out financial collapse back then, which we all know lasted for years. If it happened once, it could happen again. History doesn't repeat itself, but often rhymes, right? Well, that's an accurate statement of what's happening right now, as it's not exactly the same thing. This time it's coming from the commercial space instead of the residential. Both, though, brought on by overextended banks, lenders holding too much toxic debt. And yes, it is toxic because they can't repay it at these interest rates. Bad debt on their books, and you know it's toxic when no other bank is willing to refi it. And if enough of these borrowers default, it's only a matter of when, not if, this time bomb explodes. That means bank failures, folks, a lot of bank failures. And worst case scenario, a breakdown of our credit markets possibly, where nobody feels comfortable anymore lending money, like what we saw after '08. Now, we're going to cover a few ways to prepare for this and protect yourself for the worst case scenario. Even if you're not in the real estate space, you're not a real estate investor, it doesn't matter. But you bank at one of these small regionals, you'll want to pay attention to this. But first, take a look at what we're looking at. Again, these numbers just released. You can see all this at rjtalks.com. We have constant market research synced in and summarized from many of these big investment banks. This note is from Goldman, released last week, covering the stunning change in bank concentration of maturing loans, increasing by over 30% from a few months ago. Let me repeat that. 3 months ago, at the end of last year, end of 2023, everyone thought there would be around 600 to 700 billion in maturing CRE debt this year, a huge number. Wasn't even that people thought, that was what it was. That was what was coming due. Well, it just jumped 30% overnight to around $926 billion, folks. Why and how is that possible? How did all the analysts miss that? Well, Goldman explains why everyone got this so wrong. But before we look at that, a quick side note. If you own a business, you know that having effective communication with clients is critical for support and for sales never missing a phone call or text message, responding as quickly as possible can mean the difference between closing a deal or losing the deal. Well, did you know that you can now automate up to 90% of your client interactions nowadays? And you could do this without having any tech experience. This is all possible thanks to the sponsor of today's video, Nextiva. Nextiva is an AI-driven platform that gives you seamless, personalized customer interactions across all channels. Now, most of you know I built Snapforce CRM almost a decade ago, still run it, and I'm very familiar with SaaS applications, telephony applications, very familiar with Nextiva. And I was happy that they reached out to sponsor this video because I wouldn't recommend something that I wasn't familiar with and had confidence in. And we have countless customers who use our CRM and integrate with Nextiva. They are good, folks. I've used it myself in the past. It gives you a real corporate level phone system. It gives anyone communicating with your business the sense that they're dealing with a large, well-ran company, but very easy to use and set up at the same time. It's worth it. If you want to level up your business, make sure your communication layer is solid. They're definitely a good choice. Nextiva lets you create new phone numbers, gives you unlimited calling, texting, and an auto attendant that you can run from your phone or from your computer. You also get an AI-powered dashboard that will show you all conversations in one platform, including an AI voice and an AI chatbot that can interact with your clients for you. Again, communication's key, right? If you can't talk to the customer, let the AI do it for you. All of this is super easy to set up. You do it all from within one app. No longer will your team have to switch between 18 different apps to get the job done. You can make this one change and your business will look as polished as a Fortune 500 company, and you'll be able to focus on closing and scaling your business. This is the year to level up. Lower your costs and take full advantage of AI. Go to trynextiva.com/RJTalks or use the link down below in the description to get 50% off your plan. All right, back to this Goldman Sachs note. So what the hell happened here? How did everyone get this number so wrong? And this is the number, by the way. This number is what has Jerome Powell, the Fed, the banks, all in a panic. Has everyone scratching their heads, all of a sudden saying this may actually be much, much worse than we thought, because the number, or this high of a number, the higher this number is, the higher likelihood of bank failures. Well, look at this. It turns out, they say, in 2024, commercial mortgage maturities have been pushed up by 2023 extensions. As shown in Exhibit 3, among the CRE loans scheduled to mature in 2023, around $610 billion were refied, with around $300 billion pushed into 2024 and the remainder into future years. As a result, the total CRE refinancing volume is now expected to be around $929 billion in 2024. That is a ridiculous number, almost $1 trillion in maturing CRE debt. Look at 2024 compared to all future years this decade. It's a huge number of loan maturities, 3 to 4x higher than normal, and it's quite literally the worst possible year this could happen. Perfect recipe for some type of financial disaster. All of these loans maturing this year means the borrowers have to contend with current interest rates, high interest rates comparatively speaking. Virtually all of these loans have current rates around 3 to 4%. The majority of them do at least. So when their loans mature, they'll be looking at a new rate that's 2 or 3 times higher. And that's if they can even find a bank to refi with. As Goldman writes, most of these banks are now trying to unload this paper at huge discounts, taking the loss now instead of being on the hook if the borrower defaults completely. And it's not just Goldman who picked up on this. These bank concentration numbers are also concerning policymakers at the Fed. Days after the MBA released these numbers, Jerome Powell said this, watch.
Working from home, this is one big part of it. That means that in many cities, the downtown office district is very underpopulated. There are empty buildings in many major and minor cities. It also means that all the retail that was there to service the thousands and thousands of people who work in those buildings, they're under pressure too. And banks will have made loans to many of those buildings. Not all of them, but many. So this we've known for some years. And so what do? We have identified the banks that have high commercial real estate concentrations, particularly office, and retail and other ones that have been affected a lot. We identify them, and we are in dialogue with them around, do you have your arms around this problem? Do you have enough capital? Do you have enough liquidity? Do you have a plan? You're going to take losses here. Are you being truthful with yourself and with your owners? And so we've been working with them. And so for some time we've been doing that. And, this is a problem that we'll be working on for years more, I'm sure. There will be bank failures, but this is not the big banks. If you look at the very big banks, it's not a first-order issue for any of the very large banks. It's more, smaller and medium-sized banks that have these issues. We're working with them. We're getting through it. I think it's manageable is the word I would use, but it's a very active thing for us and the other regulators, and it will be for some time.
Thank you. Do you have concerns? Let me just ask you this. As you're talking with these small and medium-sized banks, because we know there's always could be a contagion, which we've seen in the past, do you have concerns that if they fail, that somehow this is going to impact the financial sector? And are you prepared and trying to address that and prevent that from happening?
We're trying to stay ahead of that. So we also reached out to banks that had high concentrations of uninsured deposits, and particularly uninsured deposits, and a lot of commercial real estate in the office sector. So we're well aware of that issue, and we're just trying to stay ahead of it on a bank-by-bank basis and overall.
Okay.
And so far, we've been able to do that.
Thank you.
I am confident there will be bank failures, he said. Now, why is he saying that? Well, if you look at the numbers, just the raw data, banks hold the vast majority of these CRE loans. Look at this. Banks hold around 38% of total CRE loans outstanding, not spread out in financial markets like we see nowadays with resi mortgages, where the banks package our mortgages up and sell them in a mortgage-backed security. CMBS only makes up around $200 billion. Instead, around 38% is held in-house by these banks. The banks literally are holding the paper, and among the 38%, it's not the big banks. The big banks stopped writing new CRE loans years ago. Instead, it's the small regional banks that are on the hook, and it's already beginning to happen. The loans are already beginning to fail. Borrowers, rather, are beginning to fail to make their payments. Goldman covers this as well in the report, saying this: office CMBS delinquencies have risen significantly, with January 2024 tracking at 6.3%, up significantly from 1.5% in December 2022. That's a problem. Look at this from 2 days ago. San Francisco Four Seasons Hotel investors $3 million late on loan as foreclosure now looms. Westbrook Partners, which acquired the San Francisco Four Seasons luxury hotel building, has been served a notice of default as the developer has failed to make its monthly loan payment since December and is currently now behind more than $3 million. This is what the banks are afraid of. They don't want these buildings. They don't have enough time nor the liquidity to deal with that. Not to mention the CRE market right now is in the gutter. Nobody's buying property like this today. Prices are down bigly. All it takes is a small bank to have a few of these big deals go south, a few of these big borrowers to stop paying at the same time, and a small bank goes bust. So how do you prepare and protect yourself, protect your family, your money? Well, the FDIC insures up to $250,000. Do not keep over $250,000 in a single bank checking account. If you're in that situation right now, if I was in that situation, I would change it. Getting a second or third bank account at a different bank. It has to be a different bank. If you have multiple accounts at the same bank, you're still only insured up to $250,000. Preferably, at this moment, I would use a big bank like Chase, which pains me to say, but Chase is probably the safest from risk of failure. Of course, this only matters if you have your money in a regular checking or savings account or a money market account. All right, that wraps up this episode. Like, subscribe. We'll see you next time.